Borrowed money can be used for many purposes, from finding a new business to buying your finances an engagement ring. But with all of the different types of loans out there, which is best and for which purpose? Below are the most common types of loans and how they work. Other sources: cash advances or occasionally available from other sources. Notably, tax preparation companies may offer advances against an expected Internal Revenue Services IRS tax refund. However, unless there are a dire emergency, there is no reason to give up part of your tax refund just to get the money a little faster. If you have never received a loan to purchase something, you are certainly in the minority. Loans can be great thing, but they can also get you into trouble. One of the keys to being financially successful is understanding when loans are a good solution for your situation. Loans are never a good idea if you can't afford to pay them back to the required time frame. Let's explore what a loan is and find out some of the common ways to borrow money. All loans are not created equal, but you need to borrow money. First, you will want to decide which type of loan is right for your situation. As you begin comparing loans, you will find that your credit is often an important factor. It helps determine your approval and loan terms, including interest rate. In the previous video, I also explained what is interest and what is principal. If you want to know what is interest and what is principal, then go in my channel and watch the loan video. A loan is when you receive money from a friend, bank, or financial institution in exchange for future repayment of the principal plus interest. The principal is the amount you borrowed, and the interest is the amount you charged for receiving the loan. Since lenders are taking a risk that you may not repay the loan, they have to offset that risk by charging a fee known as interest. Loans typically are secured or unsecured. A secured loan involves pledging an asset such as a car, boat, or house as collateral for the loan. If the borrower defaults or does not pay back the loan, the lender takes possession of the asset. An unsecured loan option is preferred but not as common. If the borrower does not pay back the unsecured loan, the lender does not have the right to take anything in return. There are six types of loans. Personal loan. Most banks offer a personal loan, which can be used for almost anything. Car loan. Car finance can come in four forms. Mortgage. A mortgage is a loan normally taken out when you buy a house. Home equity. Credit card loan. Payday loan. These are the loans that you can borrow. Special considerations: interest rates have a significant effect on loans and the ultimate cost to the borrower. Loans with high interest rates have higher monthly payments or take longer to pay off than loans with lower interest rates. As I also explained in the previous video that what is the meaning of longer payoff interest rates and what is the meaning of higher. For example, if a person borrows $5,000 on a 5 years installment or term loan with a 4.5% interest rate, they face a monthly payment of $93.22 for something for the following five years. In contrast, if the interest rate is 9%, the payment climbs to $103.79. Similarly, if a person owes $10,000 on a credit card with a 6% interest rate and they pay $200 each month, it will take them 58 months totally to pay the full loan back with interest, or nearly 5 years to pay off the balance. With a 20% interest rate, the same balance and the same $200 monthly payments, it will take 108 months or 9 years to pay off the card. It will take some more times to pay off the total loan. Simple versus compound interest. What is the difference between simple versus compound interest? The interest rate on loans can be set at simple or compound interest. Simple interest is interest on the principal loan. The principal loan, that means the money you are taking from the institute is the principal loan, is also called simple interest, because simple loan will be pay off with simple interest and mini interest. Banks almost never charge borrowers simple interest. The loan which are taken from the bank almost never put the interest on the loan. That's why it is also called simple interest loan. For example, let's say an individual takes out a $300,000 mortgage from the bank, and the loan agreement stipulates that the interest rate on the loan is the borrower will have to pay the bank a total of $345,000 or $300,000 cross 1.15%. The interest rate on $300,000 is 1.15%. That is mini interest. That's why the bank borrower loans is also called simple interest principal loan, because on the bank interest rate is very low.